I'm Karunya Rao and in Ideas for Profit, all eyes on Aarti Industries. While there are near-term concerns for Aarti Industries in the form of potential dip in domestic discretionary demand, investors have reasons to look beyond it. Management has not only upped medium-term earnings guidance but also unveiled its mega capex plan to fuel growth in the later part of the decade. While the ambitious plan comes with its own set of execution risk, for the given scale and proven business model in the chemical space, Aarti seems well placed to harness opportunities from the trends of China plus import substitution. Q4 revenue growth of 12% was backed by both specialty chemicals and pharma segments despite both the divisions witnessing maintenance shutdowns. On YoY basis, better gross margins helped offset higher employee and other expenses resulting in better EBITDA margins. However, sequentially higher costs due to commissioning of new units led to a dip in operating margins. Specialty chemicals results were also supported by recognition of about $5 million as part payment in lieu of cancellation of the first long-term contract. Note that in June, a 10-year contract with an MNC client was cancelled due to change in the outsourcing strategy of the client. Due to this, it has to compensate Aarti Industries with $20 million each at EBITDA level for FY21 as well as FY22. Management unveiled an ambitious capex plan worth 4,500 to 5,000 crores for the next 3 years. This includes a 1,500 crore for existing projects. Among key capex projects, commissioning of second long-term contract worth 10,000 crores for a 20-year supply of chemical intermediates is expected by Q3. Third multi-year contract announced in Feb 2019 will likely be commissioned in second half of FY22. Meanwhile, nitrochlorobenzene capacity is also likely to be delayed. It's likely to be completed in FY23. Project targets to increase NCB capacity to 108,000 tons from 75,000 tons is also on the cards. Additionally, capacity expansions are underway for US FDA facilities at Tarapur and Vapi. These expansions would cater to therapies like anti-hypertensive, cardiovascular, oncology and corticosteroids. Among newer projects with capex outlay of 3,500 crores, company would be focusing on downstream products in existing chemistries and in NCB. It is also exploring newer chemistry value chains such as chlorotoluene along with custom manufacturing opportunities. Targeted end industries range from the likes of pharma, agro, polymers and even pigments. To execute these opportunities, which will take care of growth in second half of the decade, Aarti Industries would be sweating its existing land bank at Dahej and Jagadia. To fund these projects, the management is looking to raise 1,500 crores in the form of issue of equity shares or any other instruments. Further, 2,000 crores is expected to come in from operational cash flows and rest from debt. The second wave of COVID-19 is likely to impact domestic discretionary demand a tad more than last year. While overall discretionary demand constitutes 40% of specialty chemicals business, a strong export market and resilient pharma business would help it offset the discretionary demand contraction in domestic market over the near term. Now coming to some other near-term triggers. Chlorination plant at Jagadia is also commercialized. Furthermore, as a follow-up to termination of first multi-year contract, the company plans to continue production of agrochemical intermediates used for active ingredient and sell it to other agrochemical clients. It is also comforting that the US authorities have granted a 5-year extension for dicamba-based herbicide formulations, which removes a key overhang on the company's performance and stock's performance. Moving to longer-term guidance, management expects at least 20% CAGR growth for top line for next 3 years and expects EBITDA margin to sustain around the current levels. While this is a plausible scenario, given the strong pickup in global growth and expected ramp up in recent capacities, we tend to keep our estimates at a slightly lower rate. Reason for our cautiousness is also governed by the fact that in the recent past, there have been delays in capex projects along with termination of one long-term project. Management guides that beyond FY24, operating margins should be closer to 25% given contribution from high-margin downstream products. This makes next few years a critical phase for the company as it experiments a new set of value-added products. Having said that, Aarti Industries is one of the best plays in chemicals to leverage 3 factors at move: pickup in global growth, China and import substitution. Large chemical players such as Aarti Industries are better positioned to deal with near-term hurdles with respect to operations, supply chain, working capital management, which help the company gain share in the domestic market. And hence, for a foreseeable future, Aarti should be able to clock low double-digit to mid-teens earnings growth. In case of Pharma, investors should keep a watch on value unlocking opportunity as the company may hive off this business over the medium term. In fact, an internal committee is reviewing the prospects as of now. Major expansions are expected to commercialize in the next 2 to 3 quarters. Aarti is also looking to capture increased domestic sourcing of pharma intermediates by clients due to the China factor. Further, the government's incentive scheme for APIs is also going to help in higher demand for intermediates from domestic manufacturers. And if you look at the stock, it is trading at a premium valuation of 22.2x of FY23 EV to EBITDA. Quick normalization in global demand scenario along with unfolding of growth opportunities in both pharma as well as specialty chemical space keep us constructive. Investors should watch out for market-wide gyrations to accumulate this diversified chemical behemoth. Given the elevated multiples, accumulation should be done with an investment horizon of 3 to 5 years. We believe such a vesting period is warranted to harness the company's foray into downstream value-add products and the optionality of value unlocking in the pharma space.